delighted to be here for two reasons. One is that, looking at the impressive growth journey of Wealth Nivesh, I'm glad that we got a chance to present our case, or what I think about markets in front of you. And second, I believe that most, if not all, the customer base of Wealth Nivesh are ideals. Not that they are kind of against any other clan, so to speak, but I think I myself graduated from IIT Kharagpur in the class of '96. So when he was falling at the age of 30s, whether he can call kids, I must be calling grandkids. But in that context, I have presented across the globe, and I'm glad to be presenting, and I feel as part of the community when I sort of present to the fellow audience that we have here. The task that I have in front of me is kind of talking about budget and what it means for the country and whatnot. What I would do is actually put the budget in the context of where India has been and where India is headed over the next 5 years. Now the thing is that you have heard and seen the structural growth story of India as they presented over the last half an hour or so. I would actually take you through more practical parts, which is kind of from a market context where we are headed. They say in English, hearing it fresh from the horse's mouth. Yesterday I was in Delhi, where Honorable Finance Minister and Chief of Economic Affairs had called a few CIOs to sort of hear about the feedback on the budget. So I certainly gave mine there and heard a few thoughts from their side. So hopefully, as we go along the discussion, you will gain some from this. Great. So the slide has come through. This is my mother of presentation. So allow me, as I toggle through the slides, to get to the main point of discussion today. So. My title today is Pain Before Gain. And sorry, I know India is a great story. India has been kind of doing all the rounds. But let's get down to practice. What is the issues that we have? 2024 was actually a year of elections, not just in India but globally. Some of you might be NRIs, you must have relatives abroad. You will know that more than 50% of the top 20 nations had elections last year. What that meant is there were many narratives. There were a lot of things were said and nothing got done. Okay? In some countries, leadership changed. In India, we know that the vote count went down from 400 expectations to 240, right? And it had its own implications. So likewise, across the globe, there were changes that came about. So I call 24 the year of elections. What were its implications? The implications were that, and if you hear me out, you will probably kind of understand the story. You will probably get to where I'm getting at. We started off last February thinking that we would spend about 11.5 lakh crores in capex. Okay? Now, by the time we crossed Maharashtra elections, we had only done half of that. That is the impact of elections that we've had this year. And my sense is, if I take the sugarcoating off of the numbers being talked about in public forums, this budget or this spending actually might turn out to be 8 to 9 lakh crores versus 11.5 lakh crores which we thought about. This is the capex spend, all the infrastructure and everything that we see. So that's a shortfall of 25%. On the base of India, that is hell of a lot. On top of that, consumption had a bit of a soft patch because inflation was unbelievably high. And again, taking the sugar coating off of the monthly number that you see, 5.5–6%, inflation utna nahi hai. Inflation is about inflation, the real inflation for you and me is anywhere between 12 to 15%. It's basically higher than an average salary increase that happened last year. So courtesy these two phenomena, what we saw in FY25, and you can see the FY25 point, that of the companies that are reported in India, that are listed in India, we saw an earnings cut close to about 10%. And you must be noticing the result season that is kind of come through. There will be further cut of about a couple of percentage points. What does that mean? We started FY25 with growth expectation of 15% earnings growth. And earnings growth of 15%. We are now at less than 5% growth for fiscal year 25. For people who are kind of not very financially who don't understand what is this EPS growth, think of markets as a slave of earnings. जैसे earnings grow करेगा वैसे market grow करेगा. एक very simple rule. Over 3 years and longer, this rule follows very religiously through. If earnings don't grow, markets won't grow. Right? In that context, when I say that earnings cut of 10 to 12%, matlab, when we started the year, we were talking about a 15% growth. Now we are talking about less than 5% growth for fiscal year 25. Right? April 24 to March 25, which is in front of us. And my sense is, by the time we get to end of FY25, we will call FY25 the year of no growth. Almost 15% growth is the Now, what it typically, and this was the discussion yesterday as finance ministry, so what happened? Who is the culprit? Let's fire them. So the first thing is, almost 70% of the reason behind what happened was because 25% shortfall versus what the government kind of planned to spend. And the 25 or roughly 25-30% is basically down to the consumption or consumption weakness. And that's where we are. Right? The private sector companies also didn't spend because of the third factor, which is Trump. As I said, 2024 was the year of elections, Trump taking over early 2025. Even his team members don't know what his plans are. Maybe Instagram knows better. So, given that level of uncertainty, it's very difficult to expect any sort of proper entrepreneur to put in money to work on the ground. So, private sector capex was completely absent, right? So, after this heavy dose of what India is so good, this is the practical reality. I'm sorry to wake you up in case you felt otherwise. So, that is where we are. And so, factoring all of this, you have a market correction which is of about 10 to 12%, which is very similar, surprisingly, to the earnings cut that we have seen. What were you expecting? You were expecting that earnings growth will not come through and the markets will keep going up. ऐसा नहीं होता है. There is no free lunch. If I relate to real life conditions, you must be telling your kids, if you don't score marks, then the chances of you doing better over a period of time goes down. That's simple in markets also. Markets are zero earnings. Right? That's where we are right now. And hence, I'm taking some time to get you to appreciate where we are, because there's a lot of narrative in media written about SIPs, this, that, the other. And somehow in all of that noise, the main core reason behind why we are here gets lost. And that is simply here. That earnings have been weak. And hence, my first postulation would be, till the time earnings come back, don't expect markets to rebound. And then we'll have to chart through how earnings rebound will happen. That's the next part of the presentation. But the first point is, till the time earnings rebound, it's very difficult to expect markets to rebound on what? On liquidity. That's also the risky. So that's where we are right now. So where do we go from here? Well, 2 or 3 things happen as we get to FY26, which is the period starting next year, April 25 to March 26. First of all, we are finally out of the era of elections. Okay? For the last year and a half, the entire narrative-driven world is finally coming to an end, in the sense that everybody, whosoever has to be taken into power, is there. And for the next 3 or 4 years, the macro narrative is not likely to change. It is a great starting point if you are an entrepreneur. Because मैं अभी कुछ करूँ, फिर 6 महीने में कोई और आके कुछ और बोल दे तो मेरा तो बैंड बज गया. Right? So it's the first and very important starting point. After a lot of time, after almost 1.5 years, we will move from political narrative on populist narrative to more earnings-driven environment where all this posturing is kind of out of the way. That's number one. Second, last year, and this is where probably me being in Delhi yesterday and today in front of you helps you, is that when we were talking about the reasons behind the shortfall, and in no words I said, if you spend 25% lesser, how do you expect results to come through? That is something, a very high realization in not long. And they think that in come FY26, which is the year in front of us, you will see the entire capex being spent. You are already seeing some signs of it. Right? Now, versus a 9, so they underspent last year. But from a base of 8-9 lakh crore, if they spend 11.5 lakh crore, that's almost like 25-30% growth. So meaningful comeback in government spending will happen next year. That's the second point. And the third point is, again, taking a bit of feedback from what I heard yesterday, government is a little fed up of private sector capex not happening here. It said, if last year they gave tax cuts, they will this year we are going to incentivize the consumers. So what they did is, they gave 1 lakh crore to the consumers in this budget. This is where the budget comes handy. What is the relevance of this 1 lakh crore, you might ask? So, if I put it in terms which you can appreciate, basically for a middle class consumer in India, that means your average take-home salary has gone up somewhere between 2 to 8% on the back of this tax. Okay? Across the base of India. Now, if you compare this with the salary growth in India, it's about 5 or 6%. So it's almost government giving you an additional salary hike. Not many times has that happened. So it's a meaningful sort of boost that the government has given to consumption in the form of budget. And that's why I said that if you look at FY26, you will see a balance being struck between both government capex coming back and consumption coming back. Consumption has a multiplier effect of almost about 3 to 5 times, which usually means that subsequent to that there will be production changes and capex will come. So that's kind of economics. But if you keep that aside, net, all of a sudden from a year of no earnings growth in FY25, assuming these two things come back, which is government capex and consumption, we are talking about a 17% growth in FY26. And that, ladies and gentlemen, is something worth sitting up and listening to. Because when that happens, of course, in the near term, markets have been weak, have been celebrating the earnings cut, if you may call it that way, and a whole bunch of emotional narratives in and around that. But once the growth comes back, it will kind of equally gather pace before you realize it. Then the question becomes, when will this happen? And there I would encourage patience. Okay? This correction is different from the previous correction. Because in the previous corrections, earnings were still going up. The only thing that happened is share price corrected for some macro reasons and it came back quickly. This time earnings have also gone down. We have kind of discussed that at length. So, and earnings come back takes time. If any of you and many of you run companies, you would say earnings to come back takes time. As you know, 8 quarters में turnaround नहीं होता है. So for earnings to come back, if you ask me, it will be the earliest would be this festive season. This year's festive season, which means second half of fiscal year 26. And if that happens, Basically, stock market generally preempts this. So it will be maybe 2 or 3 months prior. So as we think about over the next 12-15 months, that's the way we should think about markets in the way I think the whole situation will evolve. For the last 5 months, I have been saying that overall this is earnings-driven correction. It will take time, and nobody is or we had takers. But suddenly, when the market falls by about 10%, you suddenly realize what happened. Usually, that's how market behaves. But net, that's where we are. And we sort of said that FY26 would be a year of comeback. Okay. Now, just to go with the flow. So, if we sort of think about FY26 as a year of comeback, how do we think about investing? So, if FY26 earnings are going to come back in the back half of 26, the first thing that you should do is stay away from lump sum. Put money in more in a staggered manner all the way for the next 4 or 5 months rather than in one go. That's one thing very clear. This ain't coming back as of tomorrow, right? Nobody has been able to call the market bottoms, and neither will I tell you give you the false impression. So investment in at least a 6-month kind of an STP mode is the best way to go about this, because hopefully that way you will cover the underbelly of the market, right? And I'm sure as you sit with Wealthy Nivesh, they come and talk to you about, he was talking about different personality types, the straight shooter and all that. I would actually put the kind of investors into very simple 3 buckets, and you can think yourself in one of the 3, but you have to do this. If you can't do it yourself, sit with Wealthy Nivesh and do that, but it's very important for you to do this. One is conservative investor, second is basically a medium risk investor, and third is an aggressive risk investor. You need to think where you position yourself. What are the characteristics of a conservative investor? Market corrects by about 2 to 5%. You start reading newspapers, you get worried, you start attending events, and you are thinking about taking money out of the market. So historically you've been invested in FDs, fixed income instruments and stuff like that, and hence volatility se dar lagta hai. For them, if you think about the core part of the portfolio, the category that might suit well, in a very blanket basis would be something like a flexi cap fund. It is large cap heavy, it is kind of conservatively struck, and generally what that means is over a period of time, it will give you a bit of earnings kicker from mid and small cap, but at the same time it will give you safety. If you are in the medium risk bucket, you do feel left out when the markets go up, but when the markets go down, you don't want too much drawdown. Little drawdown, you're okay. The medium risk investor or the confused investor. Most investors that I come across fall in this category. For them, we would recommend the multi-cap as a category. Roughly 50% large cap, 50% mid and small. All ends covered. When markets rally, you participate. Markets fall, you also participate, but with lesser risk. But for then comes the third category of investors, which sometimes need handholding. This is an aggressive risk investor who have been there in markets for 10-15 years. They understand that earnings can be lumpy, stock market returns can be lumpy, and are willing to ride that through, have a horizon of 5 to 10 years or longer. For them, and they want to play the wealth creation through India, the young lot, and all of that, we've got time, a lot of them in the hands or whatnot. There, we would recommend the mid-cap with roughly about 15% to large cap, the rest being mid and small. Over a period of 5 to 10 years, you would add value, and this doesn't change, even if when we are seeing a bit of correction right now in mid and small cap. I would argue it's a good time to gradually accumulate, but gradually accumulate over time is something that I can say comes to mind. So when you think about investments, these 3 options that I suggested are for the core part of your portfolio when you think about investments. And I leave it to you, the discussion with Wealthy Nivesh, to figure out where you are and what you want to go about. The final bit of the presentation that I wanted to cover is, we talked about markets in general. We talked about the hypothesis on earnings across the market as a whole. But are earnings across the board likely to be strong? No. there are certain pockets which will do probably better than that of others, right? And at least we at Edelweiss tend to organize ourselves or our portfolios in and around those areas when we think earnings are likely to be strong. And the logic is fairly straightforward. As a CIO, one of the driving principles that I drive, not only the portfolio that I run, but my team runs, is that markets are a slave of earnings. That means wherever earnings are likely to be stronger, the stocks will do better. Sometimes in absolute terms, sometimes in relative terms. Because if earnings are good, then more than half the job is done. So, with that in mind, these are the areas where we think earnings are likely to be resilient over the next 3-5 years as part of the topic given to me as to where earnings are likely to be over the next 3-5 years. These are the pockets that will do well. And of these, I would start with manufacturing. Of course, we went through the story of underspend last year and gradual recovery in spending this year. But basically, the moot point is India's capacity utilization is a high number. Can anybody guess what the number is? Anybody else on that side? Anybody from the back? 70%. Yeah, fairly, he's right in fairly good audience. It is 79%. Why is that important? Some of you might be entrepreneurs, you would know this. That when capacity utilization reaches close to 80%, people start to think about capex. There is no other way. Your existing facilities are used. Now, you can debate whether the capex will be strong or weak, but there will be some sort of capex cycle happening. That's the reason we think that manufacturing is one sector that will do well. Hopefully, with government spending coming back, that will stand to kind of do better as well. Second is basically real estate. Now, in India, there is a term which I will introduce called housing unsold inventory. इसका हिंदी में मतलब ये होता है कि बिल्डर ने फ्लैट बना दिए पर वो बिके नहीं, सारा खर्चा हो गया पर सेल्स नहीं हुआ, right? You would be surprised to know that in India, the housing unsold inventory that is 7-year low. You are HOD of English, that is 7-year low. What that means is there is no inventory in the system. No inventory in the system. No is an extreme system. And that's the reason when in Gurgaon builder launches a project which was supposed to be there for 4 months, it gets over in 4 hours. Right? It's a bit of positioning in there, but let us go on to show that post all the regulations that we have seen, very little inventory that is there in the system. So we think real estate will actually do well. Now, if the rate cuts happen, even better, but real estate is the second set. Third is NBFCs. Now, this is one area where valuations are reasonable, and we think that with rate cuts starting to come through, they actually benefit in terms of growth prospects. So, third, that's another area that we are moving. Fourth is technology. Now, with Trump coming in and for all the narrative that he brings about in social media with regards to making America great again, if only 50% comes through, this sector as an indirect beneficiary would start to do well. And hence we kind of there is a near-term risk of some of the tariffs that might come through. We'll see how that goes. But nevertheless, we think that if you take a 12-15 month view, then technology is another sector that will kind of come up quite well. And finally, consumption. We called out, actually we started the year calling out consumption to be the dark horse of calendar year 25. The budget has clearly been a shot in the arm with almost a meaningful amount of stimulus given to consumers. We think that will be another area to grow. So net, these areas comprise about 70 to 80% of our portfolios. And we think because the strength anchors around earnings, this is a good place to be. So that brings to the end of what I wanted to talk about in terms of first a practical dose of reality with regards to with the ensuing market correction. Why? What are the reasons? And we went through that underspend from the government, and also with regards to a weak consumer, we've seen for the first time in the last 3 years earnings cut happening. That's the reason FII or no FII, we've started to see markets erosion of almost about correction of almost about 10 to 15%. Then we went about how things are likely to change as we get on to FY26. And we realized that, as we get to FY26, from a year of lost earnings, FY26 could well be the year of earnings rebound. Because two important engines of growth, investment and consumption are likely to come back. And hence, as a parting advice, basically, while of course the correction always shakes a bit of your conviction, the best way to approach a correction is understand what the reasons are which we went through, understand when, how long it will take to rebound, which we also went through, and third, designing a course of action. And the course of action could be a more staggered way over the next 6 months, and certainly that will add value to your portfolios. I'm sure in conjunction with wealth innovation, that will kind of make it shine even better. So that brings to an end of what I want